So what if you made 10 million naira profit in the accounting year, and your friend who has a company also made 10 million naira profit? But when the tax authority came, you discovered that you are paying higher tax compared to what your friend is paying. Something is wrong. That something lies in understanding what we call allowable and disallowable expenses. Now, this is how taxation works. The accountant prepares his financial statement, basically the profit or loss and other comprehensive income, and the target, the end point for him is to get the net profit. That's the profit for the year, the net profit. But when the tax authority comes to assess for tax, to compute tax, he begins from that end point. That is the beginning for the tax authority. He begins from the net profit, which is the end point for the accountant. So he begins to look at the expenses that the accountant considered in arriving at the net profit. So there are some expenses that are not allowed for tax purposes. The tax authority adds it back to tax it. Now, this is what we call allowables and disallowable expenses. In this lecture, I want to explain to you very clearly what the allowable expenses are and what the disallowable expenses are, because this is the secret to knowing whether you can reduce your tax liability or not. Now, there is a guide that I want us to remember. It is a mnemonic. It is called WREN, REN. REN, this W is silent. So if you remember WREN, you say REN. This W stands for holy. The R stands for reasonably. The E stands for exclusively. And lastly, the N stands for necessarily. If you remember REN, which is wholly, reasonably, exclusively, and necessarily, you will be able to know whether an expense is going to be allowed by the tax authority for taxation purposes or whether it is going to be a disallowable. Good. Now, let's explain. I'm going to use some expenses to explain what these expenses are, the ones that are allowable and the ones that are disallowable. But the guide is that if an expense is wholly, reasonably, exclusively, and necessarily spent for the business, then that expense is allowed by the tax authority. It means the tax authority will not add it back and tax it. So if you are ready, let's look at them. Now, I'll give you some examples of allowable expenses. The first one I want to give is rent. Rent. Now, you know that your rent is spent in your business. The rent is what you pay for using a facility for your business. So rent, the maintenance of your building, all of this, they are allowed for tax purpose. The tax authority allows it. It's not going to add it back and tax it. No. But if that rent involves an element of your personal use, for example, you are using one building for your office and for your residence, then that element that is residential is going to be removed. Basically, you will pay the one for residential will be added back and taxed, but the one for the office, the rent for the office, is allowed. Another one I want us to look at is repairs and maintenance. We've talked about rent. We've talked about next one is repairs and maintenance. All your repairs, vehicle repairs, office repairs, furniture and fittings repairs, all these repairs, as far as they are repairs of the business in the office, they are all allowed. Another one is interest on loans. Loans are taken to run a particular business in order to generate income that yields tax. So that interest on loan is also allowed. And you know the accountant will remove it before getting his net profit. So the tax authority allows it. He's not going to add it back and tax it. Another one is bad debt. Bad debt is also an allowable expense. It is allowed because they are debts that can no longer be recovered. But there's something the tax authority will do. He will go and check whether this bad debt, whether it is confirm that the person who took that debt is actually gone for good and there's no possibility of getting it back before you can classify it as bad debt, debt that cannot be recovered. If it is so, the tax authority will allow it. Another one is staff salaries and wages. This is very, very clear to everybody. You have to pay your staff salaries and you have to pay them wages. This is allowed. The accountant will list this as an expense, admin expenses, isn't it? Before arriving at his net profit. The tax authority also allows it. It's not going to add it back. If in that staff wages and salary, there is something like benefit in kind. For example, you rented a house for your director. That is called benefit in kind. The tax authority is going to add it. This also has to do with rent. I told you rent is allowed, but if part of that rent is the rent of the house of your director, or you bought a very powerful car to boost his prestige, those ones are called benefit in kind. They are not allowed for tax purpose. The tax authority will add it back and tax it. Next, we want to look at National Health Insurance Scheme, NHIS. It is allowed. In fact, if you look at the Constitution, yes, we have the NTA, Nigerian Tax Act. If you look at it, even in the past, before the reform, it was there and it is still there. So it is allowed. National Housing Fund, National Health Insurance Scheme, your pension, gratuity, all these are allowed. They are allowed to deduct them. Another one is marketing and advertisement. In as much as the marketing and advertisement were done for the business, of course, you don't advertise something. But if what you're advertising is personal, it's a personal thing, it's not allowed. But usually advertisement, promotions, marketing is usually done to get more sales. And the more sales you have, the more revenue you have. And the more revenue you have, likely the more profit you have. So this is allowed for tax purpose. Legal expenses. Legal expenses also allowed. But if it is your personal case, it is not allowed. Audit fees, cost of annual statutory audit. It is statutory. It is demanded by law, by regulation, that you have to show the audited financial statement of your company. So the auditors have to be paid. Their fees are allowed. The accountant will remove it as part of his expenses. And also, when the tax authority comes, the tax authority will also allow it. Then we have other things like subscription related to business or professional fees. We have director's fees. We have donations. Donations. Let me explain donations. Donations, it is not all donations that are allowed. Donations to a political party, not allowed. Donations to some approved charities, allowed. But donation to APC, to PDP, to all the political parties, not allowed. Good. Utilities, electricity, water rate, all of these are allowed because of what? Wholly, reasonably, exclusively, and necessarily spent for the business. Now, let's look at some disallowables. For disallowables, these are expenses that are not allowed when the accountant prepares his financial statement, that is the income statement. Before arriving at his net profit, there are some expenses that he has already removed. He has less those expenses before arriving at the net profit. Once the accountant removes them, lesses them to get his net profit, the tax authority, in computing his tax liability, will add them back because they are not allowable expenses. So we say they are disallowable expenses. They are added back. The first example is depreciation. Depreciation on assets, not allowed. Of course, everybody knows that the accountant lesses depreciation as an expense to get his net profit. But this is not allowed by the tax authority. And the reason for this is that the company gets capital allowance for that asset. So depreciation is not allowed, but something is given in place of depreciation, which is capital allowance. For example, you buy a capital asset, you are not allowed to remove the costs at once. Rather, you are allowed to remove it maybe 20% this year or 25% as the case may be, because we have different percentages for different classes of those assets. So the capital allowance is removed year to year. It might be for 5 years, it might be for 4 years, just to illustrate. So the tax authority gives capital allowance, and so depreciation is not an allowable expense. Capital expenditure, the cost of purchasing fixed assets. When a company removes those costs, the accountant removes those costs, it is not allowed, because a business is supposed to have to incur capital expenditure. So this is not allowed. It is capital in nature, and capital allowance is given in place of this. Another one is personal expenses. Personal costs, personal expenses are not allowed. When the expense is not wholly, reasonably, exclusively, and necessarily spent, but rather it is spent for personal gain, personal interest, it is not allowed. Fines and penalties are also not allowed, because you are not supposed to break the law. Whether you are arrested by VIO and charged or fined, or by the road safety, or by the police, or whatever, any penalty for breaking the law, traffic offense, whatever offense, as far as you broke the law, those fines and penalties are added back. They are not allowed. General provision. Provision for bad debt, for example. If it is general, a general provision, it is not allowed. But if it is specific, it is allowed. Good. Income tax. Income tax, we know that the accountant will remove income tax expense to get his net profit. The tax authority will add it back, because you are supposed to pay tax. I mean, why won't you pay tax? So the tax authority will add it back. It is not allowed. It is not an expense that is allowed for tax purpose. Entertainment, if it is general in nature, it is not allowed. But if it is specific for staff, it is allowed. It is something that is allowed. But if it is general, especially when it is non-business entertainment, maybe to bribe clients so they can retain your services, it is not allowed. Donations to specific bodies, listed bodies. These bodies are listed by the tax authority. If you make donations to those bodies, it is allowed. But apart from those bodies that are listed, any other donation to charity, any other charity that is not approved, not listed, it is not allowed. Another one, excessive director's fees. There is a threshold. So above approved reasonable amount, once you pay directors excessively, try to buy them houses, buy them very exotic cars and all of that, those are benefits in kind, and they are not allowed for tax purpose. Gift items, general gift items to customers, to staff, once it is general in nature, not allowed. But once they are specific, especially in the condition of service, they are allowed. But once those gift items are to clients and they are general in nature, perhaps to just pamper people, not allowed. So many other expenses that are not allowed. But the guide is every expense has to be wholly, reasonably, exclusively, and necessarily spent for that business, incurred for the interest of the business. If they are not so incurred, then they are disallowed. But once they are wholly, reasonably, exclusively, and necessarily incurred in the interest of the business, then they are allowed. I want to say that if you enjoy this class on taxation, I want you to like, I want you to share, and I want you, most importantly, to subscribe to my channel so I can continue to dish this out, give you more knowledge on financial literacy, on accounting and finance. This is the least you can do to motivate me.